Hi everyone, my name is Jade, co-founder of Legendary Real Estate Services. And if you're interested in real estate and you've been following real estate and all of a sudden now you're following the banking turmoil, I want to address the silicone elephant in the room, and namely, how does the banking turmoil affect real estate? All right, so let's dive in.
We're going to quickly cover how bad was that banking turmoil? How bad is it really? How does that specifically affect the real estate market and why? We're still not in a recession yet. This picture is from the Wall Street Journal, and it shows some of the major banks, their unrealized gains and losses and uninsured deposits. So it's not uncommon for financial institutes to have unrealized losses on their books, especially as the market fluctuates. Most of the investments were in US Treasuries, which is considered the safest asset to hold, which is why it didn't raise any red flags. So this is the picture in 2021. As you can see though, in 2022, as interest rates rose, it pushed the value of those treasury bonds down, and you saw how that picture quickly morphed. As long as they held it to maturity, everything is fine. However, if there's a liquidity issue or something forces them to sell and realize those losses, now we have a problem. How big is that problem? How does it affect the real estate? Well, according to the Federal Reserve data, banks smaller than the top 25 largest accounts for about 38% of all outstanding loans and 67% of commercial real estate loans. The biggest hurdle was the run on the banks, the hysteria, and that contagion spreading across the country, which we have avoided so far. Now it's all about the restoration of confidence, and that's why I believe the Feds had to raise interest rates, not only because the European central banks raised their rates, but to not raise rates while they're saying the banking system is fine would be a contradiction of action and statement. So they had to be in alignment. It would also show that maybe they don't know what they're doing. Now, whether they do or not, that remains to be seen. That's completely above my pay grade. However, right now they're showing a heroic face of confidence, and they're toting that the system is sound and everything is fine. If that's true, healthy yet prudent banks, they might tighten just a little bit. They'll still make loans, but they're going to probably make less risky loans because they just want to make sure that they want to watch to make sure there's no banking failures or nothing pops up or creeps up out of the woodworks. If nothing happens, they'll loosen back up in about a quarter or so. Banks that are at risk, they're going to be moving, if they haven't already, quickly to brace against fickle depositors and reorganize their balance sheet, which is super healthy for them to do. They'll respond by tightening standards and slowing the amount of lending that they do. In other words, credit is going to be somewhat more difficult and perhaps even more expensive to obtain. Best case scenario, we see all this reset and everything restores back to normal in about a quarter or so. Worst case scenario, this prevails throughout the year and maybe perhaps into next year. If that's the case, we have two counterbalancing forces. If lending tightens while interest rates continue to hike, that's going to squeeze buyers. It's going to diminish their purchasing power, thereby diminishing demand and putting downward pressure on prices. The key to watch out for is which banks do tighten, by how much they tighten, and for how long they tighten. Banks pulling back from lending in the long run, if they do this for a long run, that's going to slow the economy and slow the amount of investments. And this actually, interestingly, is a key characteristic of a recession. Even though we're not in a recession, this is what happens in a recession. It's not going to be a cookie cutter definition like it was in 2008. It will be harder though for builders to finance new constructions, thereby constricting supply even further, not just now, but in the future. Why that's a counterbalance is it's a simple supply and demand equation. As supply goes down, prices go up. So prices are going to continue to be high simply because there are less homes out there for sale and available because of the constriction of supply. If you are a buyer, you're looking to get a loan, you are sitting on cash, you can put down 20% or more, and you have stellar credit score, you're probably not going to see a problem. It's going to be business as usual. However, if you don't have a pile of cash, you can't put that 20% down or more, and you have less than stellar credit score, then you might find it challenging to, one, qualify for a loan, and if you do qualify, it might be more expensive. So you might want to adjust your expectations of how much you can afford, or sit on the sidelines for the time being and continue to work on your credit and building up your cash reserves for when you're ready to purchase. The good news is the factors that led to the recession of 2008 are not present today. First and foremost, we are sitting at 2 months of inventory. We are below 4 months of inventory, which means we are in a seller's market. A seller's market means we are limited on supply. Back in 2008, we had over 6 months of inventory. We were in hyper supply. There was supply everywhere. And so when supply goes up, prices go down. Back then, we had the inverse of what we have now. That's going to continue. The graph above that shows the national permits and starts. You can see how they are coming down. And the table below, that's from the Wisconsin Builders Association. As interest rates hiked last year, that put a squeeze on builders. And in Walworth County, we saw permits drop by about 3% in Walworth County, 22% in Racine County, and about 7% in Kenosha County. So again, we're going to see that restriction of supply, not just this year because of last year, because of the higher interest rates, but probably into 2024 with the continued hike in interest rates and potential squeezing from the banks. This is a national year-round study of home sales done by Adam Data. And what it shows is that the typical sale of medium-priced homes in 2022, the average seller, they had about 60% gain of their equity, or about $100,000 in gains when they sold last year. The reason that's good news is that if there is a significant drop in prices, most home buyers today, they can withstand it. It won't be fun by any means, but it won't put their homes underwater. All they have to do is hunker down, hold on, and just wait it out until the market rebounds. If there is, say, a 20% drop in prices, that'll bring us back to pre-pandemic levels, which isn't as bad as it seems. So the good news is that when there is a recession, homeowners are in a much better position to weather the storm than they were in 2008. This next graph shows a side-by-side comparison of December 2021 and December 2022 of delinquent loans. As you can see, foreclosures were at 0.2, 0.3%. This is an all-time low. This graph shows the national averages of mortgages that are 30 to 90 days delinquent between January of 2008 and 2022. So as you can see, we are at all-time lows. Interestingly though, if lending tightens, what that's going to do is that's going to decrease the number of delinquencies even more, because standards are going to go up and less risky loans are going to go down. So that number that we saw previously, that's probably going to go down too, especially if they tighten for the long run. Bottom line, we are past the major hurdle of just fear, bank runs spreading across the nation, and that's what government officials moved heaven and earth to accomplish, and they've been successful so far. So best case scenario, as I keep saying, if we don't have any more bank failures, the shock's gonna fade and confidence is gonna bounce back in about a quarter or so. Worst case scenario, rates continue to hike, we have more bank failures, lending is going to tighten for the rest of the year, and that's going to slow growth, slow expansion, and slow investments. Ultimately, that's going to lead to a recession. However, unlike the 2008 recession, it's going to be more of a rolling recession, which economists have said we've been in for a while, starting with the tech industry, and then people now that are dependent on that tech industry as their clients, they might start seeing it. It'll roll through different sectors. Now, this could put downward pressure on real estate, but again, the counterbalance is that restriction of supply. So we're going to have really a balance between those two forces. However, if you are a buyer and you've got sound, solid credit and you're sitting on cash, I wouldn't worry too much. If you aren't sitting on cash and you have less than stellar credit, I'd build that credit back up, save up your money, and when things rebound, you'll be in a great position. I've covered a lot. If you have questions, there is my email. Feel free to email me at any time. And if you want to get these videos, I do them on a monthly basis. Go to our website, click contact, and submit your name and email. Also, go to Facebook. I do post them on Facebook as well. Thanks for stopping by, and we'll see you in the next video. Bye now.